And you can hear me, right? Okay.
Come on, guys, I'll be dropping paid forex strategy of different forex traders in this channel for free. So don't forget to subscribe and like. Stay to the end of this video because you will enjoy a lot of benefit for free.
Right. No problem. So, because of how we did the last class now, start from market structure again. Because most people kept interrupting when I was teaching. That was why I had to use Zoom so I can meet everyone at once. And so I'm about to start from market structure again. So like so this strategy is basically liquidity based SMC. I trade market structure, liquidity, and then point of interest. So I'll go over what market structure is, the different types of market movements, the liquidity part, that is inducement, and then the point of interest part. We already covered this in the first class, but I still want to go over it again for some people that do not understand. So let me get started. So market structure is the behavior, condition, and the current order flow of the market. So make sure you get this down. I want to be as clear as I can be. So market structure is the behavior, the condition is running here, but market structure is the behavior, the condition, and the current flow of the market. So basically the current order flow of the market. And there are two types of market movements. There's the trending market and then the ranging market. So and then in the trending market, we have the uptrend and then the downtrend. And then we have the uptrend is when market is making a series of higher highs and higher lows, while the downtrend is when the market is making a series of lower highs and lower lows. So something like this is an uptrend. This is an uptrend, and a downtrend is something like this. The downtrend is so an uptrend. There is a downtrend. This is an uptrend and this is a downtrend. And then for a ranging market, this is what a ranging market is. So a ranging market is basically price consolidating from one point to another, not really making any trends. It's not traveling on an uptrend, and it's not also going on a downtrend. Basically, just moving from point A to point B, from point B back to point A. That's what a ranging market is. So I'm not going to see this thing again because after seeing this, some people instead of watching the videos, some people will still come and tell you they don't. So better pay attention to this particular class. So So market structure is the behavior condition on the current flow of the market. There are two types of market movements: the trending market and the ranging market. The trending market, there are two types: uptrend and a downtrend. And this is what an uptrend is. This is what a downtrend is, and this is what the ranging market is. This is what ranging market is. So um that being said, the structure part actually being said, what I pay attention to when trading market structure is the break of structure and then the market structure shift. Now, what's the market structure shift? Market structure shift is an indication that a trend has ended and the new one is about to begin in the opposite direction. This is what the market structure shift is. That is, for example, now let's say that market was previously on an uptrend. That is something like this. The market was previously on an uptrend. That is having markets. And you know what an uptrend is? One market is making a series of higher highs and higher lows, higher highs and higher lows. That's what it means for market to be on an uptrend. So let's say this is what market has been doing: higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, higher highs. And all of a sudden, market did something like this: lower low. This thing that happened now is a market structure shift. There's one market as the current trend is ending, and there's a new one beginning in the opposite direction. So this particular place, that price made a lower low, so you mark out as your market structure shift. So that's MSS. Stand. Market was previously on an uptrend. It failed to continue the uptrend, therefore shifting direction to the downside. This right here is a market structure shift, because the previous behavior of the market is an uptrend, and the previous behavior of an uptrend is market being in a series of higher highs and higher lows. You pay attention: higher high, the next low that comes out is higher than the last one. Higher high, the next one that comes out is higher than the last one. Higher high, higher low. But here, if market actually continued from here and made another higher low here, this would have still been an uptrend. But no, market made a lower low, meaning that this uptrend is now ending and market is about to continue in opposite direction. It is now price being on a downtrend. So that is what market structure shift is. Now, another thing I pay attention to when trading market structure is break of structure. Now, break of structure is almost the same as market structure shift, but a market structure shift, once the market structure shift happens, they're taking a trade in the opposite direction. But in break of structure, once there's a structure break, it's still going to continue trending in that same trend it was traveling at before. So break of structure. Now, market structure shift. Once the trend ends, your trade is going to be on the opposite direction. But in the break of structure, there's a structure break. We're still going to take a trade in the same direction that market was traveling at before. So this is what I mean. This market structure shift. But in break of structure, you have something like this. Let's say there's a resistance zone here, and then price was making higher highs and higher lows, higher highs and higher lows. All of a sudden, you do something like this. Understand? This is a resistance level that got broken. So this right here is a break of structure because it broke past a key level in the market while still being in the same direction that it was traveling at before. So here is a break of structure. Here, this is a market structure shift. So in the market structure shift, markets will change direction to the opposite direction. In break of structure, market will still continue being in that direction it was traveling at before, but it's going to surpass a key level in the market. Most of the time, there's a double break of structure. Once we pay attention here, market broke like it's making higher highs and higher lows. Each high that comes out is higher than the previous one. But in this case, it broke this structure again. At the same time, also broke a key level in the market. So a double break of structure. This is more valid because it gives you more confidence that the buyers are strong in this market, but this is a bearish, a bullish market. It was bearish and this happens, gives you the indication that sellers are coming into this market. This is a high impulsive move that broke out. So if I'm to take a trade now, I will still be looking for buys in this break of structure. But if I'm to take a trade in the market structure shift, I'll be looking for sales. That's the difference between market structure shift and then break of structure. Understand? So that's the difference between break of structure and market structure shift. In market structure shift, you're taking a trade in the opposite direction after there's a market structure shift. In break of structure, you're taking a trade in the same direction that market was traveling at before. That's the difference between break of structure and the market structure shift.
Come on, guys, don't forget to like this video, subscribe to this channel for more paid forex strategy course from different big forex traders that their cost is over $200, $300. I'm going to be bringing them to this channel for you guys for free. And also don't forget to sign up with my recommended broker, either XNext, World Trade, or Dairy Broker. I'm going to be dropping the link in the description and the pin comment section, and also join our Telegram community for more useful updates and premium signals. Let's continue.
Trade. So really hit. So market was on an uptrend, making series of higher highs and higher lows. So if you pay attention, you see higher highs and then higher lows. Then you see higher highs. So market surpassed this zone and also broke this resistance zone here and made an instance. So this resistance zone that it broke now has given me a double break of structure. After that, market did first this pullback, which is the inducement. And I said sometimes markets like I said, sometimes after market breaks out or there's a market structure shift and the inducement happens, majority of the times market breaks past that level and continue. You understand? But sometimes it does not break past that level. But as long as it covers at least 50% of the previous move, that is a valid pullback. So after market made this first pullback, I looked for my point of interest, which is this other block, and eventually the market tapped into that other block, swept this inducement, which is the trap, the first pullback that market makes after breaking out, swept past it and triggered this other block. And then this was the trade when I had the analysis, and then this is trade now. So I didn't take I just took small trade. It was not really much. I wasn't even planning on taking it, but I just saw it and I just had to take a trade. So like I said, the inducement is a trap. It's the first pullback that market makes after a break of structure or after a market structure shift. I want to also show it with BTC trade that I took today. So markets broke structure. This is a resistance zone. And market broke structure, like I said, higher highs, higher lows. So it broke this high here and also broke this resistance level here. After that, market made a pullback. This pullback here is the inducement. After market made the pullback, I waited for price to come back and then sweep this inducement area that it made. This is a very fast move because market was very volatile, but it's still a proper inducement. This is the first pullback. Market pushed up at least 50%. So after market broke out, made the first pullback, that is the inducement. I use this breaker block to get in. I will teach you what another block and breaker block is, but I'm just giving you an example of an inducement in progress. So you see, market was on an uptrend here. Higher highs, higher lows, higher highs, higher lows. Then this one broke this level, breaking this level and also breaking this key level, resistance level here. Like I said, in break of structure, you see trade in line with the current trend that market was at before. So after it broke this level, we also broke this key level here. That's double break of structure. The first pullback is my inducement, which is here. Market with IND. This is my inducement. So when price eventually came down again to see that inducement, it swept it because it's a trap. Trigger my main point of interest. And the traders already TP. That's this trade. So when I had the analysis this morning, so they are all this morning trade. When I had the analysis, what triggered me and TP, and then price already hit TP now. So I've explained what an inducement is. That's basically the first pullback that market makes after a break of structure or after a market structure shift. That is what an inducement is. So now I'm not going into point of interest. Now for my point of interest, I make use of breaker blocks and then other blocks. I will tell you what an order block is, and I will tell you what a breaker block is. An order block is a place, it is an area in the market where there's a lot of limit orders. Now you understand the when trading that your $100, $1,000, $10,000, even 100,000 does not make any effect in the market. People that actually move the market, the market makers, they don't trade with $100 or 1K. They trade with over $50 million, $100 million. The place is the place those their entries to be triggered. That is what an order block. So there are two types of order blocks. We have the bullish order block and then we have the bearish order block. So this is what a bullish order block looks like. You will see a bearish candle, then you will see a bullish one engulf that bearish candle like this. This is what a bullish order block looks like. This is what a bullish order block looks like. In case if you're looking for buys, this is what a bullish order block looks like. Something like this. And then for a bearish order block, this is what a bearish order block looks like. You see a bullish candle, then you see a bearish one engulf it. This is what a bearish order block looks like when you're looking for sales. So this is what a bearish order block looks like. So I'll mark it with bullish order block, bearish order block, then bullish order block. So bearish order block, bullish order block. Now for cases like this, now this bullish order block was what I used to take this trade I took on gold. Pay attention. After markets had this break of structure here, it made this. This is my break of structure. So I'll mark it up for break of structure. This is my inducement. This is my inducement here. This is my inducement. My inducement, and then this is my order block. Like I said, you see a bearish candle, and then you will see a bullish candle engulf it. That's what a bullish order block looks like. And if you this is a bullish order block right here. It's a bullish order block right here. So because I'm looking for buys, that is what I'm going to use as my order block. So this is my bullish order block. After price broke structure, made the inducement here. Now, so I've marked out my break of structure. That is the market structure part of the strategy. I've marked out my inducement, which is the liquidity part of the strategy. Now I'm marking out my point of interest. That's the next thing for me to mark out my point of interest. So I'm using my order block as my point of interest. So this is what a bullish order block looks like because I'm looking for buys. This is my point of interest part of the strategy, my pure white strategy. So when price hit that entry, I took my buy here. I see TP was hit. So if I was looking for sales, I'll be looking for sales with a bearish order block. Let me look for a trade that I took with a bearish order block. I'm just summarizing. You guys already have an idea of what this is. If you have an idea, I'll send the recording of the first class. The recording of the first class. So, yeah, the recording of the first class. But I'm just summarizing really what we've done already. So I want to look for a trade that I took with a bearish order block like this. So if you pay attention to this charts here, you will see that price was previously on an uptrend. So market was making a series of higher highs and higher lows. Pay attention here, you see it. Higher highs, higher lows, higher highs, higher lows, higher highs. The market made a lower low here, signifying a market structure shift. This is the structure part of my strategy, and I'll indicate it with MSS right here. So this market structure shift, this is MSS, market structure shift. After that, markets made this first pullback. And what did I say? My first pullback is my liquidity, my inducement. This is the first pullback that markets made. So that is what my inducement is. So I'll mark it with IND. Uh, After that, I'll now be looking for my point of interest, which is the bearish order block. And how does the bearish order block look? You see a bullish candle, you see a bearish candle engulfing it. So this is the bearish order block. You see the bullish candle, then you see the bearish candle engulf it. This is what a bearish order block looks like. So I'll mark my entry. And what the price, once price got to my point of interest, that was exactly where it reacted off of. So I've summarized. And then for people that asked how to mark your order block, now for when there's weeks in your order block, should you mark the week or should you not mark the week? I have to pay attention to this. When the wick in your order block is longer than the body of the candle, for example, let's say this is your wick, your order block. When it's longer than the body of the candle, for example, this is longer. If you're marking your entry, mark it from the body of the other block. Or if the wick on the other block is smaller than the body, can mark the whole thing and mark the wick of the other block. Or in a situation where the wick of the other block is very long and longer than the body of this other block, you're marking your entry, mark your entry from the body of the other block. That was why when I took this trade, this other block for the year. This is the trade I took. This trade. This, this, it was on gold that I took this trade. On gold. This is the trade I took today. My other block. If you pay attention, you can see the wick. The wick is very much longer than the body of this OB. That was why I did not pick my entry from here. I picked my entry from here, the body of the other block. So if the wick of the other block is longer than the body, use the body as your entry. If the wick of the other block is shorter than the body, and use the wick and the body all together. You can move from the wick. So I've basically summarized what we did in the first class. So now I can continue with the second class. I hope you saw what I did and I hope you saw what I did. Or you also you heard everything I said, but okay. Okay. So I want to go over to the second class, the main class, which is actually knowing when to use your point of interest. Now, like I said, I make use of other blocks and breaker blocks as my point of interest. Now, I've talked about what an order block is a place in the market where there's a huge amount of limit orders waiting to be triggered. That's what an order block is. So, what is now a breaker block? A breaker block is a failed order block. What do I mean by that? This is my bearish order block now, for example. Now, I would expect markets to come here and start selling. That's the normal intuition that you have a bearish order block. Markets will come there and start selling. Understand? A bearish order block is usually at the end of a bearish order block is usually at the end of like for you to take sales. So for every zone that gets broken, there's always an order block that would have triggered the opposite direction of the market. Let's say, for example, you're taking a trade for buys. Now higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. So pay attention to here. What can you see here? There's always an order block here that triggered this move to go up. There's one that also triggered this move to go up. There's one that also triggered this move to go up. So this is an order block pushing the markets up. Now, if you pay attention here, there's also an order block here that was supposed to push markets down, but it failed and markets kept going up. There's another block here that's supposed to push market down, it failed and kept going up. So for each zone that gets broken, there was an order block that was supposed to prevent that break. For example, now this is an order block here in the market. This order block was supposed to prevent market from going up. So this is a sell, a bearish order block. But if you pay attention here, market did not actually respect this order block. Markets came here and then broke past this zone. So this order block now is no longer an order block or a breaker block. So a failed point of interest is that's what a breaker block. A failed order block, that's what a breaker block is. So I make use of order blocks and breaker blocks in taking my entries. Now knowing when to use those either an order block or a breaker block is now very important. Like for this BTC trade, what I use here, the breaker block to get my entry. Because if you pay attention here, you will see this is a breaker block here. Market was supposed to react from here and start selling down. So, but market actually came here and broke past this zone. This zone now is a breaker block, and that was if you pay this a bearish order block here. This was why I used to get my entry is buy. For this BTC buy. Now, that's why sometimes now you have a trade and you have an order block, you have a breaker block. Market will not trigger your order block and you miss the trade. But you not pay attention, you not see another place the market reacted off of. That place the market reacted off of is a breaker block. I want to give an example with one chart. Here you can see this is a breaker block. This is a zone that was supposed to prevent market from going up. This is an order block, a bearish order block. But market broke past it. After breaking past it, I had to use this as my entry here. That was where I got this my entry from for this particular trade now that went up here. Same as this. This is a bearish order block. Understand? Market was supposed to react from here and start selling, but market broke past that zone. This is no longer a bearish order block. This has now become a breaker block. Now, when do you use this? When do you use breaker blocks and when do you use other block? This is when the rules comes in. The rules that you look out for before picking a point of interest. This comes in. So there are four rules that I pay attention to before picking a point of interest, and these are the rules. So number one, so these are the rules I pay attention before picking a point of interest with this particular strategy. Number one, it has to trigger a break of structure or a market structure shift. So the point of interest needs to trigger a break of structure or needs to have triggered. So now I want to go into inducement as the liquidity because what I use as my liquidity this trade is my inducement. So what's an inducement? Inducement is the first pullback. So inducement is the first pullback that market makes after there is a break of structure or a market structure shift. So this line is the first pullback that market makes after a break of structure or a market structure shift. So something like this now, for example, this is a break of structure. After market break structure, there's usually a first pullback that market makes. The pullback, after the market makes that pullback, the market continues traveling in that direction that it broke out into. Majority of the time, it breaks past the last high it made. Some of the time, sometimes it does not break past. There's something like this. This is a break of structure. This is an inducement. That's the first pullback, and the market will still continue going up like this. Sometimes it does not happen. Sometimes there's a break of structure. Like let's say this is a break of structure right here. And market does something like this, pulls back a bit, goes up a bit, then still comes back. This is still a valid break of structure. At least it has to cover at least 50% of the previous move the market did. But this is an inducement, and this is also an inducement. Understand? So when market does something like, and this one is a trap, basically, it's a trap. It induces price to come down there. So once price comes down, it sweeps off that inducement. So the inducement is a trap in the market. First pullback the market makes after a break of structure or a market structure shift. So in the market structure shift, for example, this is a market structure shift. Market will do something like this, make a first pullback, then go down. Eventually, will now come, shoot that first pullback and trigger the main point of interest before eventually going down. So the inducement is what I use as my liquidity. The inducement is the first pullback that market makes after a break of structure or a market structure shift. So I want to find a chart with a break of structure and show you guys. So this trade I took this trade today. This is gold trade. This is the before of the trade. This is the before of the trade when I had the analysis here. And this is the current outcome. Got the market structure shift. That's number one rule. So if you pay attention to all the trades I took today, there was a break of structure here. That was why I took the trade. There was also a break of structure here. So there has to be a break of structure or a market structure shift. That is the number one rule. Second rule is it needs to have liquidity protecting it. Now, if having liquidity protecting is what I say is my liquidity inducement. So it means that you need to have an inducement protecting it. That's what it means. That's to trigger a break of structure. The number two, second rule is it needs to have liquidity protecting it. That's liquidity slash inducement. That's what makes a high probability point of interest. The third one, it needs to be unmitigated. Now, what I mean by it being unmitigated is after price triggered a break of structure or a market structure shift, price needs to not have tapped into that zone after that break of structure or market structure shift. This is what I mean. Let's say this is my breaker block, and then this is my other block down here. And then price does something like this and then breaks out of this zone. After breaking out, it made the first pullback. This first pullback now did not mitigate this breaker block. You understand? That's what I mean. Not before the breakout. Once market has broken out, you have to make sure that the point of interest you're using did not get tapped into during that first pullback that market is making after breaking structure or after triggering a market structure shift. You have to pay attention that market did not tap into it. That's what I mean by it being unmitigated. That's what I mean by it being unmitigated. So number two rule says it needs to be unmitigated. And then the fourth rule is it needs to be the point of interest closest to liquidity. Now, it needs to be the point of interest closest to liquidity. Now, what do I use as my liquidity inducement? So if you look at all these rules and you follow it correctly, make sure you're getting these rules down. Look at all these rules and you follow it correctly, you can have 80 to 90% win rate with this strategy. Number one, it has to trigger a break of structure or a market structure shift. Number two, it needs to have liquidity or inducement protecting it. Number three, it needs to be unmitigated. And number four, it has to be the point of interest closest to liquidity. So now this is when you now know when to use your breaker block and when to use your other block. Now let me make a more graphic presentation of what I mean. Now let's say the market was on a downtrend before. Let's say okay this, and the market was making and the market was making, I was in this for example. So this is a resistance level. The market is doing this higher highs, higher lows, higher highs. Why is my actually using this behavior? Fine. Can you hear me properly? Chidera, I don't know what you're saying. Can you hear me properly? And can you see what I'm doing properly? If you can, then you tell me. Can you see what I'm doing properly? Can you hear me properly? Chidera, fix your network. Okay. Chidera, fix your network. So, let's say this is price, and then price is making higher highs and higher lows, higher highs, and then price does something like this, breaks out of this zone. Now, this is a break of structure right here. After breaking out, price now does something like this. This is the first pullback and goes up again. So this is your inducement right here. So this is my break of structure. This is my inducement. Now, as you already know, as price broke from this zone, this is going to be your breaker, the zone that it broke out from. That is normally market was supposed to react from here as a resistance level or as an order block that was supposed to push market down, but it broke past it. After breaking past it, it made this inducement. Now pay attention that this zone, this your breaker, was not mitigated by this first pullback. When market made the first pullback, it did not touch this breaker block. So now, as you know, the breaker block is going to be here. The other block is going to be probably somewhere here. Now, this is the breaker block right here. This is the other block. So I'll mark it out. Breaker, other block. Now, what you have to pay attention to after a break of structure or a market structure shift is that first pullback. It's very vital for you to pay attention to it. It's very crucial. That will tell you whether to use a breaker block to pick your entry or whether to use an order block. Now, if you pay attention to the first pullback that market made, it did not mitigate this breaker. And so now what the rule says it has to trigger a break of structure or a market structure shift. It did. It triggered a break of structure. Second rule says it needs to have liquidity or inducement protecting it. It has inducement protecting it. The third one says it needs to be unmitigated. Is this one, this breaker is unmitigated. The other block is also unmitigated. But the fourth rule now says it has to be the point of interest closest to liquidity. And if you pay attention to it here, the breaker block is a point of interest. The other block is also a point of interest. But which point of interest is closest to liquidity is a breaker. That was why when markets come here to eventually sweep this inducement, they will not buy from this other block. They will buy from the breaker block. Why? Because the breaker block is a point of interest that is closest to liquidity. And it matches all the four rules in picking a point of interest. That was why in this particular trade, um, that's why in this particular trade here, what is the trade? And the trade now. In this trade, I think trade. In this trade, pay attention. This is a breaker block here, and this is also an order block here. Now, when market broke out, this is the first pullback that market made. This is the inducement right here. First pullback. This is the inducement right here. Now, this is your breaker block, and then this is the other block down here. This is the other block down here. Now, what you're paying attention to, the first pullback that market makes. So market broke out of this zone. This is the first pullback here, inducement. If you pay attention, the inducement did not mitigate this breaker block. After the first move, after the break of structure, yeah, market made the first pullback, which is here the inducement. But the inducement did not mitigate the breaker. That was why I used the breaker as my buy entry. That's why I used the breaker as my buy entry. But if when markets broke structure, that is something like this. Let's say market broke structure, something like this. Market broke structure, then does this as the first pullback, mitigating this breaker and then going up again. If market eventually comes back to sweep this inducement, what I'll use as my point of interest will be this other block. Now, why will I use the other block? Because one of the rules says the point of interest needs to be unmitigated. Now, because this breaker block has been mitigated, I can't use it again as my entry because it does not fit those four criteria I have in my rules. Now, the first pullback is here, which is this inducement. Now, one of the rules says the point of interest that is closest to liquidity. So, because this zone has been mitigated, I can't use it anymore. So, which one is now the closest point of interest to liquidity? It is this other block. Now, I think gold, I use another block to take a trade today, and I will show you the reason for this strategy. So this is the gold trade. So this is a break of structure right here. I use the 3 minutes time frame. So this is a break of structure right here. This is the breaker block that was supposed to push markets down. This is the breaker block that was supposed to. So after market broke structure here, This is the first pullback that markets made. Now pay attention that when markets made this pullback, it's mitigated this breaker block and also mitigated this breaker block also. This is because this is the first pullback. And then when markets pushed up again, eventually when markets came to sweep this inducement, it didn't buy from the breaker block anymore. Why? Because the first pullback that markets made after the break of structure mitigated this breaker block. That was why markets now came to buy. It bought from this other block instead of buying from the breaker block, because the breaker block had already mitigated. So I've drawn out diagram for the block. And so let me draw the diagram for other block also. Pay attention here. That was why I use this breaker as my entry. Market broke structure. This is the first pullback. The first pullback never mitigated this breaker block. That was why as I marked my inducement, the point of interest that I used was this breaker block. If not, I would have been looking to take trade from, I think there's another block I saw here. I think this other block here. So I would have been looking to take my trade, and I would have missed this trade. Why? Because this point of interest is very much valid. Price never mitigated it after the break of structure. So that's why I make use of 2 points of interest, breaker blocks and other blocks. And following these rules that I wrote down, you now know when to make use of breaker block and when to make use of an other block. Once you follow this rule properly, you're not going to be lost. Once you pay attention, even if your point of interest has a break of structure or your market structure shift, after finding out if it has it, you pay attention if there's an inducement there. If the inducement is there and is valid, you now pay attention if the point of interest you have to pick, which one has been mitigated. The one that's been mitigated, you're not going to make use of it. So if the breaker block was mitigated after a break of structure or a market structure shift, you don't use the breaker block, you now need to use the other block. But if after market broke structure or had a market structure shift and the breaker block was never mitigated during the first pullback, you now use the other block. Now use the breaker block as your entry. So in this case, this breaker block was never mitigated during the first pullback, so we use the breaker block as our entry. But in a case like this, market does something like that. Going up higher highs, higher lows, higher highs, higher lows. The market does something like this, breaking out, and this is the first pullback. If not, the first pullback mitigated this breaker. After that, market will go up a bit. Now come down to sweep this inducement. Now, because this breaker block has already been mitigated during the first pullback, you can't use this breaker block as your entry anymore. Now have to pay attention to the other block. Take your buy. You understand? So this is your breaker, and then this is your other block. So this is it. So knowing when to, that's why in the gold trade I used other block, because I used another block in the gold trade. Because when price broke out, the first pullback mitigated the breaker. But in this BTC trade, I used a breaker block, because in the first pullback, price did not mitigate the breaker. So that is it for point of interest. Now you can ask a question. And ask a question. If you have a question, just type so I can unmute you. What do you mean show an example? I just showed you an example with the chart. Just showed an example here with the chart. You see if I also have trade that I've taken before. Okay, this trade, price broke out from this zone. After breaking out, this is the first pullback that market made. The first pullback did not mitigate this breaker block. There's another block down here. There's a breaker block down here. Because after price broke out, it did not mitigate this breaker block. My entry was from this breaker. Let me find an example of using an order block and then an example of using a breaker block. I've already given an example on when you make use of a breaker block on gold. Multiple examples, actually. Multiple examples on gold making use of a breaker. That's this, that has this example of a breaker block here. Also, Here, here, pay attention. Market, this is a break of structure right here. After market broke structure, this is the first pullback that market did. You can see it's a tiny pullback here. This is your inducement. This is the first pullback the market made. This is it. After that, market continued pushing up. Eventually, the price came down and then swept this inducement to trigger this breaker block. So markets used this breaker block to buy because market had not triggered this breaker block during the first pullback that it did. So if you have a question, indicate in the comment and I'll unmute you. The inducement on BTC actually went up 50%. Where is it? Actually, let me look at 3 minutes time frame. Actually did go up to 50% on BTC. If you pay attention, this is it. This is the whole inducement of BTC. This is the move here. From here to here. This is the BTC inducement because I was looking at it from 5 minutes time frame. But this spike, market was very volatile at that moment. But this spike, how is this not 50%? From this to this, is this bigger than here to here? This is more up to 50% move. Let's calculate it from here, this zone right here. This 329 pips. And then from here to here, this is up to 50% move of this. It most times is because of the volatility of the markets. When this happened, there was a lot of volatility on the market, so everything was really moving fast. But there was a break of structure. I saw my inducement. Then I went in. I have a question. Can we see GG? GG trade. I also took a loss on this trade, but I already figured out why I took a loss on this trade. Now let me unmute you. Who is that? That's correspond with higher time frame. That's to make sure you're trading with general trend in the market. You have to make sure. Yeah, candle rejection is also an inducement. As long as it pulls back, it's also an inducement. Who said I should open up BTC chat? I cannot meet this person. AJS. Uh-huh. I sent you a request. Unmute yourself.
Yes, yeah.
Yeah, good evening.
Can you hear me?
Yeah, I can hear you.
So yes, for this exact same setup, I had the same thing on GG, but I was taken out. So I really do not know why, because there's inducement and there's a breaker block, but the setup failed.
I had the same setup, but I already figured out why it took a loss on the trade. Now, this is a general downtrend in the market. This is a general downtrend. Price already swept this zone, triggered this other block. So market is selling. So this right here is actually our market structure shift. After market shifted structure, it made this pullback here, which is the inducement. So this was other block that was supposed to use to take a buy, but it failed. So this is actually a breaker block. We're supposed to be looking for sales on this trade and actually sell it down from that zone to here. So this little structure move, this uptrend is actually just creating liquidity here to go and trigger this breaker block here. So the trade was actually a sell here down to this zone. Because if you pay attention here, this was an uptrend. The market actually shifted structure down here. After shifting structure, this was the first pullback he made. This first pullback did not mitigate this breaker block. After that, price eventually came up, triggered this breaker block, then sell. So the overall direction of this market was actually bearish and not bullish. This market was in a narrow downtrend. Do you understand now? Do you understand? You are mute. the general structure was actually bearish. So we're supposed to be looking for sales on the trade. This is, see if you pay attention here, this is it now. Higher highs, higher lows, higher highs, higher lows, higher highs, then lower low. After doing that, he made the first pullback, but the first pullback did not mitigate this other block that was supposed to hold the buy. So this is the breaker block now. Eventually, the price pushed down, not pushing down. That is the pullback, the inducement. Price now came to trigger that point of interest and sell. I actually made the mistake myself. I was really looking for buys on this trade, but I took a lot. But I looked at it and I discovered what I did on the trade. Um, let me tell you. There's no particular time frame I get. I've talked about this thing before. I don't know. I talked about this time frame thing before lots of times. Where I see my point of interest is where I'm using and where I take it. I don't have a particular time frame that I use to look at things. If I'm on the 1 hour time frame, after analyzing, and I know I'm looking out for another block or a breaker block. If I don't see it on the 1 hour time frame, I go down to another time frame and look for it. And for how many candles that you need to have to consider a point of interest, an inducement. It does not matter how many candles it is, as long as there's a valid pullback. It can, on 1 hour time frame, it can be a single candle. On 2 hours time frame, a single candle. On 5 minutes time frame, it can be 10 candles. Everything else depends on time frames. How do I know the trend on a higher time frame? I already taught trending markets and then ranging markets. You identify the trend by knowing what is making. And if it's making higher highs and higher lows, you know that the trend is bullish. If it's making lower highs and lower lows, trend is bearish. EU. I also took a Ireland lesson EU. But I'm not going to be checking trends for everybody. I'll check like 2 more. Took a loss on, I think. That should check EU, which time frame is that? I'm not going to check everyone. I'll just check this one. Yeah. I have another block on 1 hour, and I have another one in 15 minutes time frame. I don't understand. I think two other blocks or something. I don't understand. You pick the point of interest that is closer to liquidity. Like I said, pick the point of interest that is closer to liquidity. If a 1 hour time frame order block is also going to be a mini order block on 15 minutes or 30 minutes, it's going to be, how many candles see those? As long as the structure gets broken, I don't understand the question you're asking. How many candles do I need to consider a break of structure? Does not matter as long as the structure is broken. It can take 1 candle, 2 candles, 3 candles, 5 candles, as long as the structure gets broken. And everything depends on the time frame that you're checking your this thing on. Because on daily time frame, it can be one single candle. On 1 hour time frame, it can be three candles. On 5 minutes can be 10 candles. Time frame is just what determines everything. You understand how I match this which breaker block on which pair? Which one? Is it this trade? I was not really taking this trade serious. When I saw this trade already pushed up, but this one is from this other block actually. This other block down here, that was where the entry was gotten on EU. But I said on trust the analysis, it was from this other block. But when I saw it already pushed up, I was not I did not take this trade, but it's from this other block. I don't know if you're talking about Euro USD. You mark your break of structure. Break of structure is the body, not from the wick, is the body. No, if the pullback does not happen after the break of structure or after the market structure shift, is not an inducement. The pullback has to happen after the break of structure and after the market structure shift. Can't consider the one that happened before. On EU is already bearish actually. EU is reacting from this other block here. That was why EU buys. were failing. There was a break of structure. There's an inducement. I was not looking at the overall trend of the market. That was what fucked me up. This is your inducement after the break of structure, after your structure shift here. This is the other block. And then EU was selling from that. Supposed to even sell and clear this zone too, because this is trend line. I'll teach about trend line about liquidity types in the next class actually. This trade is still invalid itself because this is trend line liquidity. So markets are actually supposed to clear this entire liquidity zone. So this is the other block that EU is reacting from. This is the structure break. Yeah. This is the inducement. So it's reacting from this other block. That was why it was selling. And that was why this our buy actually. But I didn't pay attention to this side because but I still did not even take the trade. I did not pay attention to this side. Market block structure here. This is a block of structure. Market block structure here. Broke this zone here and also broke this zone. This is the other block. This is the inducement. So that was why EU buys failed. Because market was in a downtrend. You must not do top down if before the breakout keep up the previous candle printing. I don't understand. If before the breakout you keep having pullbacks to the previous candle printing, I don't. Like I said, the pullback has to happen after the break of structure. Anyone that happens before the break of structure does not matter. Pay attention after the break of structure and after the market structure shifts. Do I think it's good to set buy or sell limits on your point of interest or wait for confirmations? If you're active, stay active, and then once your trade hits your entry, you take it. I don't wait for any confirmation. When price hits my point of interest, I enter automatically. The reason I don't set entry is most of the time external broker does not really trigger anybody in. So majority of the time I'm active on my laptop. I'm literally doing nothing. So I'm active on my laptop and I can take a trade while watching it hit my entry. So that's just it. As long as it follows how the trader that took a loss and notice that it's a sell with a breaker block. I've answered this question pretty sober many times. Told you this. You guys keep asking me questions that I don't really understand. I've mentioned this in like many times. It has to be after a break of structure. Any kind of pullback that mitigated the point of interest before the break of structure is not valid. It, it being mitigated is after a break of structure or after a market structure shift. We'll see the top-down analysis. Just find the overall trend of the market. The only thing you look out for is the market structure, inducement, and then your point of interest. You find the market general market structure, you find the inducement, and then you find the point of interest. If you want to do your top-down analysis, you find just get the market structure. If whether market is bearish or bullish. After you've noticed a break of structure or a market structure shift, get your inducement and then mark your point of interest. The questions you guys are asking me here, I'm not even sorry, I'm not even related to this strategy anymore. So this is what basically what it is for the second class. I will send the recordings. You watch and then ask me questions related to what I thought. Please, I really answered enough questions. I'm reading these questions, but they're not related to what I thought. Watch, I will send the recordings of this class to the group, so you watch the recordings. Then make your analysis with what I thought here, or you can backtest. And if your trade fails, come to me for corrections. I see most people make an analysis and send me the analysis for me to say if it's right or not. I don't think whether analysis is right. It's only if it's not right, then I can look at it and then correct you. There are over 100 students here and I cannot be correcting 100 analysis every time. You analyze and you show me your chart and tell me whether it's correct or not. The next topic of the class is liquidity. You know you want to take your profit using liquidity. types of liquidity. That is trend line liquidity, higher equal highs liquidity, equal lows liquidity, long week liquidity. That's what I'm going to. That will tell you, like, that was why I looked at this trade and I knew that this market was still going to sell more because this is trend line liquidity and market has not taken it out yet. So I'm still expecting market to sell, take out the trend line liquidity. People can even start looking for buys on Euro USD. So there are types of liquidity actually in the market. There's trend line liquidity, which is one. There's equal highs liquidity. This is equal highs liquidity here. That was why I knew that this zone was going to be taken out. But the thing Euro USD was that it did not trigger my point of interest, but it still took out this equal high liquidity. This is an equal high liquidity. What market makes an equal high or an equal low. There's liquidity resting above that zone. That's why I marked out this zone because price will eventually come and then take out that liquidity. This is also trend line liquidity. I'll teach more of that in the next class. This trend line, I'm going to see take out this entire liquidity zone. The market is trending higher highs and higher lows with lower highs and lower lows. The opposite direction the market is going, the opposite direction of it, there's liquidity being built up there. And once market starts reversing, to clear that entire zone. And to set your SL, you set your SL below or above the invalidation zone. If I was taking my trade from this Euro USD order block, my SL would just be below that zone. Can just shoot myself slightly below the zone. Once I've gotten the particular candles that I'm taking my trade off of, my stop loss is going to be below that zone. I'll answer this guy below or above that zone. If I'm taking a trade from a breaker, for example, let me give you an example for it. This breaker now, where I'm taking my SL is still above or below that zone. This is a breaker block. My SL is going to be above this candle zone that I got. I would normally take my entry for. If I was taking a buy, I would take my entry from here. So my SL will just be slightly above that zone, just to be safe. I'll answer Williamson's question. So let me unmute him.
All right. Sorry, Mr. Tony. So first thing first is I want to get something in your use of breaker blocks. So the first is, does the breaker block has to be from the external side of the liquidity market, like you showed on, I think, GBP, JPY, from the other side where it's returned. So look at where you marked out as your block, breaker block. So usually this is what I do. The last low, which is this one before where you marked out, yes, no, the right, the long wick. Exactly. That is where I actually mark out as my breaker block for bearish, what's it called, momentum. And most of the time, I tend to like put my markups there to enter the trade and expect it to go down. And then most of the time, I chop stop loss like mad. So my question, from what I've seen here, yours is from like the other side of the market.
Oh, it does not really matter. Why I used to this because this is a long week. A week is not a point of interest actually. A week is liquidity.
Mm-hmm.
Like I said, there are types of liquidity, equal lows, equal highs. The week is liquidity. Normally, this I'm taking this trade I see this week does not actually exist because the function is not in here. Whenever there's a week or in any place, market actually goes to pick out that week. Now, normally this is what I would still would have used as my breaker. If this week was not here, I'm just ignoring this week totally. Understand? I'm ignoring the week
Okay.
because it does not function anything. Just let's say manipulations in the market or do you understand? I know you understand what I mean. So I want to give you a proper example using another chart. So
For a bearish trend, please.
let me think. Let me see if I can find a trend for a breaker. Okay. I think here actually. I don't know if this. I don't think. Let me see if I not really seen one, but it does not. Why I'm active from that external side is because it was just a long week I was there. But if the breaker block actually was coming like it was like immediately, the breaker block came immediately before the market structure shift or or after it, like before it. That's what I mean. I would have marked it from that immediate zone. Well, because there was not valid point of interest there, just a long week, and the long week is not a point of interest. You understand what I mean?
All right.
Yeah, that was why.
I think this makes sense.
Hey, this for example, we use this buy side, but this is a breaker, for example. Now there was no long wick here. That was why I used it. But even if there was a long wick candle here, I would still make use of this zone because this is not a point of interest. So this is basically Quasimido, right? Algo entry model.
Yeah.
So this is
hmm
so even if there was a long wick,
So,
there, I would still
so a quick question on this specific place that you are known. So you have this guy. You have the first, like the most recent high, which was sticking out, and then you have the second one beneath it, like the one under. Go to the left. Let me show you where we have the long wick. Yeah. Sorry, not the long wick. The long bearish candle.
yeah.
From there, actually, so from the top, I would, if it was me, I would have mapped it. No, not from the top. Where there is first a break, like it went down and went up a little bit, and then continued going down. By the left, sorry. No, you are there.
Just coming from is it here?
No, the other one at the top.
This one.
No,
Okay, this one.
no. The one with the long wick, the one where there is a long, not wick, candle, black handle.
Yes.
Yes. So on that exactly, on this specific place now, I would have mapped it out as my breaker block instead of the first one on the top. What do you think about that? Oh,
That's actually not a breaker block because that is not the external thing that go. It's still a breaker block actually, but price already mitigated it. I don't know. From here, this is a mitigation. Price broke, got here, and then made an equal an equal high with the other block, and then this small candle here is a mitigation. I don't know. This is mitigation. I don't know if you can say this mitigated.
oh.
So I can't use it anymore because it's already been mitigated. Besides, I'm looking at the immediate one. Understand? The immediate breaker block.
Okay, the most immediate breaker block. Okay.
Yeah, most immediate.
All right. So I think that's all actually from my end. But if you have the time right now, please, can you just show us like an example of a breaker block for the bearish trend? I would really want to, like, I think I'm doing something wrong, which I really want to correct because I don't chop stop loss now.
I don't really take sales at all. I don't mostly myself. I don't think I have. I think this is a breaker block actually. You can pay attention to this. This is another block that failed to hold. You can see.
Okay.
So this is a breaker block. So this I used the immediate one and not from the extended side. The immediate one because there was no long week.
Okay. All right. Thank you.
I don't make use of fair value gaps. I only use breaker blocks and other blocks. So please, this will be the end of the class. If you have any more questions regarding the strategy, please analyze. Most people they say I don't respond to them. Once you analyze, wait for the outcome first, using what I thought. Journal out your outcome. If it fails, there's nobody that thinks that there's a failed and then I will not address it. If it fails, then come to me. Then I have to look at the chart and see what made me fail. Not if you analyze, that be asking myself if I'm giving you setups. Understand? So analyze, journal out your outcome. Then if it fails, then that's when you now come. Not you analyze the same thing out. How is this? Or analyze and tell me, would it go well or not? So please. Okay, that'll be the end of this class. Actually, I'll send the recordings to the group and I'll open up the group so you guys can talk and discuss.
If you watch this video to the end, don't forget to subscribe, like, see you in the next video, and sign up with my recommended broker. Bye for now.